Hello everyone. So here we are with another revision video. Like if you see last time Satya sir posted a revision video for AS12. So continuing that series, we are now going ahead with the revision of AS11, the effect of changes in foreign exchange rates. This session will be structured into three topics. I am going to divide the standard AS11 into three topics. Topic 1, I'll be discussing about accounting for foreign currency transactions, mainly how to account these foreign currency transactions, how should initial recognition be done, and what will be the treatment as at the balance sheet date. That will be topic number 1. We will quickly revise the principles of AS11 and we'll also see certain interesting sums that ICA has asked both in the book as well as in the past questions. Then the second topic will be translation of financial statements of foreign operations, which is your integral, non-integral. Again, we will revise the principles and do one sum which is there in your book. And the last topic will be on accounting for forward currency contracts, which we will again discuss the topics as well as do a sum which is there in your past examination paper as well as in your textbook. This is how it will be structured. So let's get started with the first topic, which is accounting for foreign currency transactions. Okay, so in this topic, first thing is AS11 defines foreign currency transaction as a transaction which is denominated in or settled in foreign currency. In simple terms, keep it like this: any transaction, be it buying goods, selling goods, borrowing money, lending money, any transaction, if it is expressed in a currency other than INR, because for Indian companies the local currency is INR, so any transaction which is expressed in a currency other than INR becomes a foreign currency transaction. Any transaction which is either expressed or if it needs to be settled in a currency other than INR, that transaction becomes a foreign currency transaction. It can be any transaction. It can be buying goods, selling goods, buying fixed assets, selling fixed assets, buying intangibles, selling intangibles, borrowing money, lending money, going and investing in foreign companies. Any transaction you take, if you are dealing in foreign currency or in currency other than INR, it becomes a foreign currency transaction. The moment we enter into a foreign currency transaction, the very important aspect is we will be exposed to changes in exchange rates. When you are dealing in India only in INR, you need not bother about exchange rate. But when you are going to deal in a currency other than INR, you have to be very much aware about exchange rates. If you can see now how much dollar is strengthening and rupee is weakening. So whenever you are entering into a transaction, a currency other than INR, always keep in mind even the exchange rate movements as well. This topic is the main point which the standard is going to deal with. Okay, so whenever you are entering into a foreign currency transaction, very simple. The initial recognition of that foreign currency transaction, initially when you are first time passing journal entry in your books of accounts, that foreign currency transaction will be translated into INR from foreign currency by using the exchange rate on the date of transaction. Very simple. On that date, see what is the exchange rate. Using that exchange rate, convert from foreign currency to INR. That's what I have mentioned it as spot rate. Spot rate means the exchange rate on the date of transaction. There won't be any change in debit rules, credit rules. It is same as the earlier modern rules that we have learned. Sir, suddenly for foreign currency transaction, purchase will be credit and nothing like that. Same modern rules. Your debit, you know, credit, you know. Only thing is, you have, while writing in the amount column, you have to convert from foreign currency to INR using the exchange rate on the date of transaction. So this is the first point, a very important point. Initial recognition of a foreign currency transaction should happen at spot rate, or in other words, it should happen using the exchange rate on the date of transaction. Okay, sir, initial recognition is fine. But what about the subsequent measurement, especially at the balance sheet date? What should we do at the balance sheet date? Here is where the standard gets interesting. The standard says on the balance sheet date, whatever assets and liabilities you have, whatever assets and liabilities in foreign currency you have, that you need to split into whether it is a monetary item or a non-monetary item. Remember, on the balance sheet date, all the assets and liabilities which are expressed in foreign currencies needs to be differentiated into which one is a monetary asset or liability, which one is a non-monetary asset or liability. Sir, how to do that distinguishment? How to identify whether a particular asset is monetary or whether it's a non-monetary item? Simple. Standard says a definition for monetary. If the definition is satisfied, it is monetary. If the definition is not satisfied, it is non-monetary. So we should know the definition of monetary very clearly. Something that doesn't satisfy the definition of monetary becomes non-monetary. So what is the definition of monetary items as per AS11? AS11 says monetary items can be assets or liabilities that are receivable or payable in fixed or determinable amounts of money. AS11 says if you have an asset and you're going to receive that in terms of money, and you know how much you're going to receive, then that becomes a monetary asset. So just one small example. For example, assume you have a foreign currency debtor. Debtor is an asset and you're going to receive money in future, and you know how much you're going to receive now itself, then it becomes a monetary asset. Any asset where you're going to receive money in future and you know how much you're going to receive now itself, or if you can find out that, then that becomes a monetary asset. Similarly, any liability where you have to pay money in future, and you know how much you have to pay in future, that becomes a monetary liability. All the others will become non-monetary assets and liabilities. Simple. This is the definition that is given in AS11. Okay, you can remember it like this. Okay, think about it like this. On the balance sheet date, there is an asset. Now, because of exchange rate changes, if it is going to impact your future cash flows, then that is a monetary asset. If any exchange rate changes are not going to impact your cash flows, then that is non-monetary. Simple. For example, you have a foreign currency debtor. Assume I am selling to a customer in US for $1 lakh. Now think and tell me, on 31st March, if exchange rate changes, won't it affect my cash flows in the future? Because if exchange rate is 90, 1 lakh into 90, I will receive 90 lakhs. But if exchange rate becomes 80, 1 lakh into 80, I will receive only 80 lakhs. So keep this point very strong in your mind. If exchange rate change is going to affect your cash inflows or cash outflows, then that becomes monetary asset or liability. But if exchange rate changes is not going to impact you in any way, then that becomes a non-monetary asset or liability. Let me take a quick example for a non-monetary asset or liability. Assume you are buying a plant and machinery from US and you have already paid the dollars to US. Now you have a plant and machinery as at 31st March which you have purchased from US. Now think and tell me, if exchange rate changes, do you think will there be any impact on this machinery? No sir, suddenly if exchange rate becomes $1 is equal to 100, this plant and machinery will produce more. If exchange rate becomes $1 is equal to 80, this plant and machinery will produce less. Nothing like that is going to happen. Your exchange rate change will not impact the plant and machinery. So that becomes a non-monetary asset. Sir, that means simpler. On the balance sheet date, if the changes in exchange rate is going to impact my cash inflows or my cash outflows, that becomes monetary asset or liability. All the others are non-monetary assets or liabilities. This is a very, very important distinction because the accounting will totally change based on this distinction. Sir, what is AS11 telling? AS11 says, if it is a monetary item, then as at the balance sheet date, you should again restate that item using the closing exchange rate. For example, assume you sold goods to someone in America for $1 lakh on 1st February. Okay, on 1st February, when you sold for $1 lakh on credit, you would have passed the entry debtors account debit to sales account. Assume on 1st February, the exchange rate is $1 is equal to 80 rupees. Then it will become 1 lakh into 80. 80 lakhs will be the amount that you will pass for this journal entry. So debtors account debit to sales account, 80 lakhs, 80 lakhs. Now come to the balance sheet date. On the balance sheet date, assume $1 became 85. So now for the same $1 lakh, if 85 is the exchange rate, you will receive 85 lakhs. So your debtor increases from 80 to 85. Your asset is increasing by 5 lakhs. That 5 lakhs is your foreign currency gain, which needs to be transferred to P&L. So every monetary item as at the balance sheet date, you should recalculate that again using the balance sheet date exchange rate, and any forex gain or loss you have to take it to P&L unless you are going to apply the exception given in para 46A, which I will be going next. Sir, what if it is a non-monetary item? Sir, very simple. Non-monetary item, you no need to do anything. Keep it as it is. Don't change the values. No restatement if it is a non-monetary item. I hope this is very clear. Guys, remember, initial recognition, use spot rate and pass the journal entry. On the balance sheet date, take the assets and liabilities which are expressed in foreign currency, split them into monetary assets or liabilities and non-monetary assets or liabilities. If it is a monetary asset or liability, take the balance sheet date exchange rate, again convert using that rate. Whatever gain or loss should be taken to P&L unless you have applied the exception given in para 46A of AS11. But if it's a non-monetary item, then you need not disturb that. You need not restate. You can retain it at the same value. This is what AS11 says. Okay. Now, the last topic in the first section, which is on para 46A. Now, the default option in AS11 is any foreign exchange gain or loss should be taken to P&L. Be it gain or loss, everything should be taken to P&L. That is the default provision that is given in AS11. But to give a relief, there is also an option given, and that option is given in para 46A of AS11. That is why this is called practically as para 46A. Tomorrow if somebody is saying para 46A option, para 46A option, they are talking about what we are going to discuss now. Okay. Sir, what does para 46A says? Para 46A says that, listen, for para 46A, it is optional. It is not mandatory. Okay. If you want, you can avail this option. If you don't like this option, then use the default route where all the foreign exchange gain or losses will be taken to P&L. But if you want to avail this, then you can take this option of para 46A. Sir, what para 46A says? Para 46A says, if there is any exchange difference on long-term foreign currency monetary items. First, listen, this para 46A applies only to long-term foreign currency monetary items. This para 46A doesn't apply to short-term foreign currency monetary items. If you have a short-term foreign currency monetary item, sir, what do you mean by short-term? Where the total life of that monetary item is less than or equal to 12 months, it becomes a short-term foreign currency monetary item. In that case, you cannot apply this para 46A option. Whatever foreign exchange gain or loss is there, that should be taken to P&L. This para 46A option comes into play only if it is a long-term foreign currency monetary item. So please be careful. See in the question whether it is a long-term item or a short-term item. Don't just go and conclude and say para 46A can be applied. Only for long-term monetary items, para 46A will be applicable. Sir, what is AS11 saying for these long-term foreign currency monetary items? AS11 says, if this long-term foreign currency monetary item relates to a depreciable asset, you have to check why have you taken this long-term foreign currency monetary item. For example, assume I have taken loan from US, which I will repay only after 3 years. The life of this loan is more than 12 months. So it is short term or long term? Obvious, it is a long term foreign currency monetary item. Sir, why did you take this loan? I took this loan for purchasing a plant and machinery, which is a depreciable asset. So here there is a long-term foreign currency monetary item which is being used for a depreciable asset. In that case only this will apply. In that case, AS11 says, okay, you have a long-term foreign currency monetary item. You have used that for a depreciable asset. In that case, AS11 para 46A says, whatever foreign exchange gain or loss that is there, that need not be taken to P&L, using this option, instead of taking the foreign exchange gain or loss to P&L, you can adjust it against the cost of the depreciable asset. In other words, instead of debiting the foreign exchange loss to P&L, you can add it to the cost of the asset. Same way, instead of crediting the foreign exchange gain to P&L, you can subtract it from the cost of the asset. That means this foreign exchange gain or loss, instead of going to P&L, it will go to the asset and get adjusted against the cost of the asset. The revised cost will be depreciated over the balance life of the asset. This is what para 46A says. If long-term foreign currency monetary item relates to a depreciable asset. Sir, this is okay. What if it doesn't relate to a depreciable asset? What if I am taking a long-term loan from US to buy a land which is a non-depreciable asset? Or to be more specific, to buy a freehold land which is actually a non-depreciable asset. Or sir, I am borrowing long-term loan from US for working capital purposes. In that case, in both these situations, the long-term foreign currency monetary item is not being used for the purpose of a depreciable asset. Then what AS11 says, in other cases, whatever exchange difference means it can be gain or loss. Any exchange gain or loss will be accumulated in a separate account called as FCMITDA. This FCMITDA applies only if it is used for situations other than depreciable assets. Sir, what is the full form of FCMITDA? FCMITDA stands for Foreign Currency Monetary Items Translation Difference Account. அந்த மாதிரி ஒரு கவனி, அந்த மாதிரி ஒரு தனி அக்கவுண்ட்ல we have to accumulate this foreign exchange gain or loss in a separate account called as FCMITDA. That FCMITDA will be taken to P&L over the balance life of the loan. This is what para 46A says. Basically, what this para 46A does is, instead of taking foreign exchange gain or loss immediately to P&L, they are giving you an exemption where you can take it over number of years. Instead of hitting your P&L immediately, it will go to P&L over more than 1 year, so that your impact on P&L reduces. That is what is the relief that AS11 para 46A is trying to give to the users. Of these accounting standards who are preparing the financial statements. I hope this is very clear. Please remember, para 46A is optional. It is not mandatory. It is applicable only to long-term foreign currency monetary items. It is not applicable to short-term foreign currency monetary items. This is what mainly I wanted to discuss with respect to the first topic of this standard, which is accounting for foreign currency transaction. Sir, okay sir, too much dose of theory. Shall we get to some sums? Okay, let us solve certain sums. Just a minute. These two PDFs will be available as a link in the description. You can access them. Let us do one sum for this first topic. Let us see this interesting question. It is also there in your textbook. A Limited has borrowed $10,000. They have borrowed $10,000 in foreign currency on which date? On April 1st, 20x1 at 5% per annum annual interest, and they are using this loan for a depreciable capital asset. This information is very, very important. The exchange rates are as under. On 1st April 20x1, the exchange rate is $1 is equal to 48. On 31st March 20x2, that is at the end of the year, exchange rate is $1 is equal to 51. Okay. Now let us see what they are asking in the question. You are required to pass the journal entries in the following cases. First one, the option under para 46A is not taken. You are not taking option. That means whatever exchange gain or loss that is coming, that will be taken to P&L. So shall we see what are the journal entries? Very simple. When you borrow loan, what will be the journal entry? Bank account debit to loan account. That is the first journal entry they are passing. Bank account debit. Since it's a foreign currency loan, to foreign loan account. Can you pass the entry in dollars? No, the entry should be passed in INR. Sir, what is the exchange rate that we need to use? When was this loan taken? This loan was taken on April 1st. On that date, exchange rate is $1 is equal to 48. So 10,000 into 48, it will be 4,80,000. This will be the first journal entry, bank account debit to loan account. Now, if you take loan, you have to pay something called interest also. So how much is the interest? 5%. So 10,000 into 5%, $500. Okay. Remember, many students will do a mistake of multiplying that 5% on 4,80,000. No, that is wrong. You have to pay interest in dollars. So always calculate interest on dollar loan amount. So that is why I have done 10,000 into 5%, $500. Generally, when will you pay interest? At the end of first year. When you are paying at the end of first year, your exchange rate is 51. So the amount will be 500 into 51, 25,500. This is the amount of interest that you have to pay to that foreign currency lender. Okay, please don't do the mistake of applying the 5% of on INR amount. Always when you are borrowing a foreign currency loan, calculate interest on foreign currency principal amount, not on INR amount. Remember this point. So for that interest account to bank, ICA is calling that interest as finance cost, which is correct. Next, now on the last day, there should be one more entry. If you see, this loan is a monetary item, because if the exchange rate changes, your cash outflow changes. Now when the exchange rate was 48, it is enough if you pay 10,000 into 48, 4,80,000. But today exchange rate became 51. That means you have to pay 10,000 into 51, 5.1 lakhs you have to pay. You have to pay 30,000 more. So that 30,000 extra is a foreign exchange loss which needs to be taken to P&L, because in the first case you are not availing option under para 46A. So the journal entry will be forex loss account debit to foreign loan account 30,000. Clear everybody? This forex loss should be taken to P&L because this company is not availing the option under para 46A. Sir, what would have happened if the company availed the option under para 46A? The first two entries will not change. This will be the same, but only thing is the last entry, the foreign exchange loss, instead of taking that loss to P&L, since we are claiming this option and since it is used for acquisition of depreciable asset, you have to add this foreign exchange loss to the value of the asset. It should not be taken to P&L. It should not be taken to P&L. If you see, first two entries have not changed. Bank to loan and finance cost to bank account. Those first two entries will not change. Only what will change is the treatment of this foreign exchange loss. That foreign exchange loss should not be taken to P&L. It should be added to the value of the asset. Okay, sir, where is that answer? Just a minute. So if you see here, earlier in case 1, they had debited P&L. But now instead of P&L, they will add it to PPE because it was used for acquisition of a depreciable asset. So that loss should be added to the value of the asset. I hope you are very clear with this. This is a very interesting question which covers multiple topics. Case 3. The loan was taken to finance the operations of the entity and not to procure a depreciable asset. That means they are taking para 46A option. But now they are changing the use of that loan. That loan is not being used for acquiring a depreciable asset. Instead, that loan is used for other than depreciable asset. Then just now we discussed, if the long-term foreign currency monetary item is used for cases other than depreciable asset, then the exchange gain or loss should be accumulated in a separate account called as FCMITDA. So if you see here, now instead of debiting PPE, they have debited a separate account called as FCMITDA. Sir, simple, sir. If I don't avail para 46A, the loss will be debited to P&L. If I avail para 46A and if it is being used for the purpose of acquisition of a depreciable capital asset, then it should be added to the value of the capital asset. No, sir, it is not being used for a depreciable capital asset, then it should be taken to a separate account called as FCMITDA, foreign currency monetary item translation difference account. This is what is this question all about. A very interesting overview of almost most of the concepts in the part 1 of this standard. Okay, then let's go back to part 2, section 2 of this standard. Section 2 of the standard deals with translation of financial statements of a foreign operation. So first of all, what do you mean by a foreign operation? Foreign operation means either a subsidiary or an associate or a joint venture or a branch which is in a country other than India. Now in India you have the holding company, but subsidiary company is in US. Then that US subsidiary is a foreign operation for the Indian holding company. Or no, sir, I have a branch in UK, or I have an associate in Australia, or I have a joint venture in China. If you have any of these, subsidiary or associate or joint venture or branch in a country other than India, that becomes a foreign operation. Now first, very important point is, why this section is relevant is, in this section you will be given the trial balance of the foreign operation. Now foreign operation will do the entire accounting in foreign currency, and when you're going to consolidate their accounts with the main holding company's accounts which is in India, you cannot add INR and dollars. That foreign operation, the original accounting they will be doing in their foreign currency. Now to consolidate, you have to convert that foreign currency to INR. So the main purpose or objective of this topic is, we need to know how to convert a foreign currency trial balance into INR trial balance so that it can be consolidated or integrated into the head office or holding company's books of accounts, which is maintained in INR. That is the main purpose of this section. So very important thing is, first identify whether a foreign operation is integral or non-integral. Then based on whether it is IFO or NIFO, okay, from now I'll be calling integral foreign operation as IFO and non-integral foreign operation as NIFO. IFO, NIFO, because our rules for converting that foreign currency trial balance into INR trial balance is different for IFO and different for NIFO. So we need to be careful and first identify whether our foreign operation is IFO or NIFO. So let us see what AS11 says is, if your foreign operation is IFO. Now in trial balance, you will have multiple things. In trial balance, you will have income, expenses, you will have assets, you will have liabilities, you will have capital. So now we are going to discuss each item, how to convert that into INR based on if it is IFO or if it is NIFO. The rules will change. That is why it is very important to identify whether a particular foreign operation is IFO or NIFO. Let us see what AS11 says. AS11 says, whatever opening stock that you have in your foreign operation, that will be converted using opening rate, means exchange rate at the beginning of the year. Both for IFO and NIFO, take the exchange rate at the beginning of the year, use that to convert from foreign currency to INR. Sir, what if it is closing stock? You will use closing rate. Sir, simple. Opening stock, opening rate. Closing stock, closing rate. What do you mean by closing rate, sir? Exchange rate on the date of preparation of financial statements, which in most cases will be 31st March. So very simple rule, both for IFO and NIFO, opening stock, opening rate, closing stock, closing rate. Okay, now let us see. Next, revenue items, which means all income and expenses except depreciation and goods received from HO. HO means head office. Okay, here we are excluding these two things. Those two which we are excluding, we will discuss that separately below. First, let us take what about other income and expenses, sir, except these two. That needs to be converted using average rate. What do you mean by average rate? Average rate is equal to opening rate plus closing rate divided by 2. Very simple. They will give you opening rate in the question, they will give you closing rate in the question. Okay, if your fate is good, they will give you even average rate in the question. Even if they don't give you, it is very simple. Take the calculator, add opening rate, add closing rate, divide by 2. You will get your average rate. Using that average rate, convert from foreign currency to INR. Okay, sir, till now IFO and NIFO, the rules were the same, but from now it's going to change. Be careful. Depreciation, we excluded depreciation above. Depreciation for IFO, we have to use the exchange rate on the date on which we purchase the fixed asset on which you are charging the depreciation. Remember, if it is IFO, for that fixed asset, when we purchase, there will be exchange rate. Using the same exchange rate, we have to convert this foreign currency depreciation to INR. So if it is IFO, use the exchange rate as at the date of purchase of asset. If it is NIFO, non-integral, you will convert still using the average rate. Next, goods received from HO and head office account. This one, remember, whenever there is any balance between head office and branch, no need to convert that. Sir, why, sir? If you don't convert, how will you get the INR amount? Very simple. Hey, in branch books, we will have goods received from head office. That will be in foreign currency. Yes, sir, we have to convert that. Wait. In head office books, you will have the same contra, which is goods sent to branch. Their INR amount will be there. Take this INR amount, no need to convert. They remember, in case of any balances between head office and branch, no need to convert. You can take the actual INR amount which is there in head office books. So that is what I'm telling. Take it from the head office books. No need to convert. Last three, fixed assets and other non-monetary items. If it is IFO, we will use the exchange rate on the date of transaction. But if it is NIFO, we will still use the closing rate. If in case of other monetary assets and liabilities, even for IFO, we will use closing rate. NIFO also we will use closing rate. And if there is any contingent liability, it will not be accounted. Contingent liability will always be only disclosed. Even that you need to translate using closing rate, both for IFO as well as NIFO. Okay, please learn this table very well. This is very, very important. Okay, now for each item in trial balance, we are using different exchange rates. So obviously, the trial balance which is translated into INR will not tally. It will tally only if you convert all of them using same exchange rate. But here, are you doing that? No.
Each one you're using one exchange rate. Sometimes you're dealing opening rate, sometimes you're dealing closing rate, sometimes you're dealing average rate. If you use different rates for each item, why will the Indian rupee trial balance tally? It won't tally. There will be a difference. So what AS11 says, if it is IFO, take the difference to P&L. It will be either a gain or loss in the P&L depending on what is the nature of that difference. But if it is NIFO, it should not be taken to P&L, but it should be taken to a separate reserve called as FCTR, foreign currency translation reserve. Remember, this comes only in the case of non-integral foreign operations, not in the case of integral foreign operations. Integral foreign operation, which is IFO, whatever foreign exchange gain or loss is coming as a difference in the trial balance, that will be taken to P&L. If it is NIFO, it will be taken to a separate reserve called as FCTR, foreign currency translation reserve. Sir, what should we do with this FCTR? This FCTR will be shown as a reserve, and only when you sell this foreign operation, remember this, only when you sell this or only when you dispose of this foreign operation, that time only this FCTR can be transferred to P&L. Otherwise, it should still be there only as a reserve. Only once you sell this foreign currency operation, which is NIFO, only then you can transfer this to P&L. This is a very important point. This is applicable only for NIFO. So very important point is, first identify whether it is NIFO or IFO. Based on identification, use the respective rules, convert into INR. The trial balance will obviously not tally. The difference, if it is IFO, it will be taken to P&L. If it is NIFO, it will be taken to a foreign currency translation reserve, which is FCTR. Okay. Now let us see a sum so that you will also be more comfortable. Let us see a sum for this. Just a minute, I'll open that sum. Okay, let us see this. Okay, a business having head office in Kolkata has a branch in UK. So this is a foreign operation. Okay, the following is the trial balance of branch as at 31st March 20X4. So they have given the branch trial balance, which will be obviously in pounds because it is in UK. Now they are telling it there is a machinery which was purchased on 1st April, 5,000 pounds. Then they have given debtors 1,600 pounds, opening stock 400, goods received from head office 6,100 pounds, sales 20,000, purchases 10,000, wages 1,000, salaries 1,200, cash 3,200, remittances to head office 2,900, head office account 7,400, creditors 4,000. Okay, they have given a trial balance in GBP, Great Britain pound. Now they have given certain adjustments below the trial balance where they're telling closing stock is 700 pounds. Okay, and depreciation at 10%, read the line carefully, is to be provided. That means they have not passed journal entry. We have to provide this depreciation. That is why it is not there inside trial balance. It is there outside the trial balance. Now the questions asked is very simple. Prepare the trial balance after converting it into Indian rupees. It says exchange rate of pounds on different dates are as follows. On 1st April 20X1, no, many students will make a mistake. Sir, 1st April, sir. So this is the opening rate, sir. No, that is a blunder. That is a mistake. Why, sir? See the question carefully, sir. The question says their year end is 31st March 20X4. That means the year beginning will be 1st April 20X3. How can it be 1st April 20X1? Then there is a rate given for 1st April 20X3, right? This is the opening rate. Sir, then why is this given? This is given for our fixed asset machinery, which is a non-monetary item. For that it is given. If you see, this was purchased on 1st April 20X1. This should be converted using this rate. And then 31st March, this is the closing rate. Sir, so we know opening rate, we know closing rate. Sir, but the question doesn't say whether it is IFO or NIFO. Don't think I have missed copying here. It is not there in the ICA textbook also. Okay, they have not mentioned whether it is integral or non-integral. It is a miss from their side, so we hope that in the examination question it will be mentioned. Sir, then what we should assume now? ICA has answered assuming it as IFO, integral foreign operation, integral foreign operation. Okay, so let us also answer assume it as IFO. Sir, then tomorrow in exam if they don't give, what can we assume? You can also assume it is integral, but please give a note. Okay, whatever your assumption you're taking, write it clearly in the form of a note so that it's very clear to the examiner that what your assumption is, it is IFO or NIFO. Okay, now sir, one more thing, average rate is not given. Very simple, opening rate plus closing rate by 2, 63 plus 67 by 2, which is 65, is the average rate. So let us get into the answer. Let us see how to convert each one. First one, machinery. We all know machinery, PPE, it is a non-monetary item. So this will be converted using the exchange rate on the date of purchase of this asset. This asset was purchased on 1st April 20x1. On that date, exchange rate is 5,000 into 61. It will become in INR 3,05,000. Debtors, it is a monetary asset. For monetary assets, we have to use closing rate. So 1,600 into 67. We have to use 67 here. Opening stock, we already discussed, it is opening rate, which is 63. Goods received from HO, there is no need to convert because you already know how much is the INR amount in head office books. So use that same INR amount from the head office books. Don't again translate. Sales, it is income, so we will use average rate, which is 65. So 20,000 to 65, 13 lakhs. Purchase is an expense, again we will use average rate. So wages is an expense, average rate. Salaries is an expense, average rate. We will multiply and find out the INR amount. Cash is a monetary item. Remember, cash is a monetary item. It should be converted using closing rate, which is 67. Sir, what about remittance to HO? Hey, again it is a HO balance. So for that HO balance, you need not convert. They will give you how much is the INR amount from head office books. You can use that. So this 2,900 pounds, you will write in actual terms as 1,91,000. Same way, head office account also, no need to convert. Like how in branch books we have head office account, similarly in head office books we will have branch account. That will give you the INR amount. Take that INR amount. So 7,400 pounds is what is there in branch books. Correspondingly, the contra entry in head office books is 4,90,000. So instead of converting that, for 7,400 pounds, write the actual INR amount, which is 4,90,000. Last one, creditors. Creditors is a monetary liability. You have to use closing rate, which is 67. So 4,000 into 67, 2,68,000. So whatever is there in the trial balance, you have converted that. Sir, what about closing stock and depreciation? No, they are outside the trial balance. So you will also write it only outside the trial balance. So now what you have to do? You have to total the debit side and as well as credit side of the trial balance. Obviously, it will not tally. There will be an exchange difference. Since we have assumed it as IFO, it will be taken to P&L. It will be taken to P&L. Closing stock, it is, we have to use closing rate, which is 67. So 700 into 67, 46,900. Depreciation, it is IFO. So we have to use the same rate that we used for fixed asset, which is 61. So 5,000 into 61, 5,000 into 61 will be 30,500. Hope you are very clear with how to convert these foreign currency items into INR. Learn this table very well. It is a very, very important one for your preparation. This table, this PDF fully will be uploaded for you. This is very, very important. Okay, so this is on section 2. Moving on to the last section, which is accounting for forward contracts. Accounting for forward contracts. So can you simply explain in simple terms? I'll give you a small definition of what is this forward exchange contracts. See, now whenever you have a foreign currency asset or liability, you have some risk. Okay, or let me tell you like this so that it become more simple. Keep it like this. Forward contracts means in future with some other party you are going to buy or you're going to sell foreign currency at an agreed exchange rate. Okay, see, sitting today, I cannot say what will be the exchange rate after 1 month. As per today's circumstance, I cannot even tell what is tomorrow. That much fluctuations are happening in exchange rate, correct? So future exchange rate can be anything. We cannot predict exactly. So what sometimes people will do, they will enter into a contract with another person. In that contract, what they will write is, in future, either I will sell you foreign currency or I will buy from you foreign currency, and you have to tell me what is the exchange rate that you're going to use today itself. That type of contract will be called as a forward exchange contract. Okay, here we should be aware of certain 2 or 3 terms which are important for understanding. One is spot rate, another one is forward rate. Kindly excuse my handwriting. And then there is something called as premium or discount. Okay, let us just quickly understand these terms so that you will also be comfortable with the questions. Spot rate means exchange rate on the date of entering into the forward contract. It is today's exchange rate. Forward rate means it is the exchange rate that is agreed in the forward contract, which is applicable for the future. Okay, spot rate is exchange rate on the date of entering into forward contract. Forward rate is the exchange rate that is applicable to the future, which is already agreed in the forward contract. Sir, what do you mean by this premium or discount? If your forward rate is greater than spot rate, then it is premium. But if your forward rate is less than spot rate, then it is discount. Okay, simple, sir. If forward rate is more than spot rate, premium. If forward rate is less than spot rate, it is discount. Now, a person can enter into these type of forward contracts for 2 reasons. One is for the purpose of hedging. These are genuine people. They have some risk which they want to protect themselves against that risk. So that protection is called as hedge. So they are entering into a forward contract to protect themselves from the risk, to hedge their risk. Those people are called as hedgers. Some people will not have any risk, but they will want to play with the exchange rates. They are called as traders or speculators. Now the accounting will change depending on whether you are a hedger or whether you are a trading or speculator. What does AS11 say? If you are a hedger and you are entering into a forward contract for the purpose of hedging, then whatever premium or discount is there, that should be taken to P&L over the life of the contract. We will also be seeing an example, so you'll be understanding with numbers. Keep it in mind for now. If you are entering into a forward contract for the purpose of hedging, then what you should do, any premium or discount should be taken to P&L over the life of that contract. For example, if that contract is entered into for 3 months, then this premium or discount should be split across 3 months if you're a hedger. Okay, but if you are a trader or a speculator, you will not bother about premium or discount. On every balance sheet date, you will check what is the market value of the contract and you will account that market value. This is what is called as mark to market or MTM. Okay, let us see 2 small sums which is given both in your ICA study material as well as it has been asked in the past. You will have more clarity on this hedging and trading concepts. Question number 3. Power Track Limited purchased a plant. So they purchased some plant, not that plant and machinery. They purchased a plant and machinery for $50,000 on which date? 31st October 2016, 10 years back. payable after 6 months. So they have purchased the plant now. They will pay money after 6 months. Okay. Now here they have a risk. Sir, what risk, sir? They have purchased plant and machinery. No, sir. After 6 months, you have to pay $50,000. And if exchange rate changes, whatever you have to pay changes. So you have a foreign currency risk. You want to protect yourself from that risk. So you are entering into a contract called as forward contract for protecting yourself against foreign currency risk. So this Power Track Company Limited is a hedger. They are not for trading or speculation. They have a genuine risk which they want to protect themselves. So this Power Track Limited is a hedger. Okay. So they are entering into a forward contract for 6 months at 64.25 per dollar. So the exchange rate that is agreed in the forward contract is 64.25. So this is the forward rate that is agreed in the contract. On 31st October 2016, that is today, 61.5 per dollar is the exchange rate. So this 61.25 is spot rate. So if you see, the forward rate is 64.25, your spot rate is 61.5. So your forward rate is more than spot rate. You have a premium. You have a premium of, if my calculation is right, I think it is 2.75 per dollar. 64.25 minus 61.5. Now what is the question asking? You are required to calculate the amount of profit or loss on forward contract to be recognized in the books of the company. Simple. Profit or loss means this premium is there now. You are a hedger, so this premium will not go to P&L immediately. It will be taken over the life of the forward contract. Here life of the forward contract is 6 months. Life of the forward contract is 6 months. So you will take it to P&L over a period of 6 months. Sir, how will I know how much? Per dollar, just a minute. Per dollar it is 2.75, we calculated just now. And how many dollars? $50,000. So 2.75 into $50,000 will be 1,37,500. This will be taken to P&L, not immediately, over a period of 6 months. So over a period of 6 months means per month, let me just quickly put it in a calculator. Per month, how much it is? 137,500 divided by 6. It is 22,917. And this financial year, how many months we have? We are on 31st October. So November, December, January, February, March. So 5 months we have into 5. So 1,14,585 will be taken to the P&L of this year, and that 1 month amount, which is how much? 1 minute. 137,500 minus 114,585. 22,915, the balance amount will be taken to P&L in the next financial year. Oh, sorry, I think sorry, I think I was hiding this calculation. Let me just quickly show you the calculation again so that it will be useful for you. So we had calculated as 2.75 per dollar premium into $50,000, which becomes 1,37,500. Now this 1,37,500 should not go to P&L immediately. It should be taken over a period of 6 months. So per month it is 22,917. Per month it is 22,917. In this year, how many months we have? 5 months. November, December, Jan, Feb, and March. So into 5, 1,14,585 will go to P&L of the current year. For the next financial year, remaining 22,915, because that 1 month comes the next financial year, this will go to next financial year P&L. I hope you are very clear. This method should be followed only if you are a hedger. So please read the question clearly. Understand, if he is trying to protect his existing risk, he is a hedger. For a hedger, premium or discount should not be taken to P&L immediately. It should be taken over the life of the contract. No, sir, this guy is a trader or speculator. He is not having any risk. He is simply entering into forward contract to make profits. Then that guy is called as a trader or speculator, which we will see in the next sum. Fourth question. Mr. A bought a forward contract for 3 months. So life of the forward contract is 3 months for $1 lakh on the date of 1st December when the exchange, on 1st December, at which exchange rate $1 is equal to 47.10. So forward rate is 47.10. When exchange rate was 47.02, be careful, this at $1 is equal to 47.1, that is forward rate. On 1st December, which is the date of entering into the contract, on that date exchange rate is 47.02, so spot rate is 47.02. First identify this clearly from the question. Forward rate is 47.10, spot rate is 47.02. Obviously forward rate is more than spot rate, so it is a premium of 0.08 per dollar. Okay, on 31st December when he closed his books, the exchange rate was $1 is equal to 47.15. okay, that is the year end. On 31st January he decided to sell the contract at 47.18 per dollar. Show how the profits from the contract will be recognized in the books. Please remember, the first point that you have to be very clear in this question is this Mr. A is not a hedger. He is not having any risk which is trying to protect. He is a trader in forward contract. For him, the principle is different. You cannot do this sum like how you solved the previous sum. Their Power Track Limited was a hedger. Sir, what should we do for this question? If you are a trader, very simple. Ignore this premium or discount. Don't even consider that. Sir, then what I should do? At what rate you purchase this forward contract? 47.1. At what rate you sold it? 47.18. You purchase something for 47.1. You sell it for 47.18. That means you have a profit of how much per dollar? 0.08 per dollar. How many dollars? 1 lakh. So total profit is 8,000, which will be taken to P&L on the date of sale of this forward contract. Clear? So please, very important thing is read the question and try to identify whether that particular person is a hedger or a trader. That will decide the accounting treatment of forward contracts. Hope you have clearly understood. Very, very important point here is hedger or speculator. So this is what mainly I wanted to discuss on all these three topics. Don't worry, video is not yet done. We are going to discuss one or two more interesting questions which ICA has asked in the past. We have completed all the principles of this standard. Let us do certain interesting questions which ICA has asked. Sixth question. Okay. Trevor Limited is an Indian importer. It imports goods from TrueView Limited. So there is a company called Trevor Limited. It is importing goods from TrueView. Situated in London. TrueView is in London. Trevor Limited has a payable of 50,000 pounds. Okay, Trevor Limited has to pay to TrueView how much? 50,000 pounds. Okay, as on 31st March 2023. TrueView Limited has given Trevor Limited the following two options. What Trevor Limited is telling True Limited? What True Limited is telling to Trevor Limited? You have to pay me 50,000 pounds. I am giving you two options. One, you give me immediately. Today itself, pay this 50,000 pounds. Since you are paying me today itself, I will give you 1% cash discount. So effectively what will happen? Out of 50,000 pounds, I need not pay 1%, which is 500 pounds. So I will end up paying only 50,000 pounds minus 500 pounds, 49,500 pounds. This is the first deal. This is the first deal. Okay. Second deal, you need not pay immediately. Pay me after 6 months. But when you are going to pay late, I will ask for interest. Okay. So TrueView is very simple. What they are telling, you pay me immediately, I will give you discount. If you don't pay me immediately, if you want to delay, okay, allowed, then pay me interest. This is what is that options given by TrueView to Trevor Limited. The borrowing rate for Trevor Limited is 15 rupees per annum if they want to borrow in rupees. The following are the exchange rates. On 31st March 23, that is on today's date, our exchange rate is 97. on 30th September 2023, that is after 6 months, because in option 2 they have given a time of 6 months, the exchange rate is 99. You are required to give your opinion to Trevor Limited on which of the above two options will be chosen. Now we are an advisor to this Trevor Limited. We have to tell Trevor whether they have to choose option 1 or option 2. Sir, how will we decide? Obviously, if option 1 is leading to a lower cash outflow, option 1 is better. If option 2 is leading to a lower cash outflow, option 2 is better. So for that, first we have to find out what is the cash outflow under option 1 and option 2. So first let us see option 1. Option 1 is you have to pay immediately, and when you pay immediately, how many pounds you will pay? 49,500 pounds you will pay, because you will get 1% cash discount, and for that the exchange rate is 97. So effectively you will pay 49,500 into 97, which will be 49,500 into 97, which is 48 lakhs 1,500. Okay, now many students will stop here thinking this is the outflow. No, to pay this 48 lakh 1,500, you have to borrow in India. Otherwise, from where will you get this money? So you have to borrow this money in India, and for borrowing that money, you have to take a loan at what interest rate? 15%. So effectively what you are doing, you are taking loan from an Indian bank at 15% per annum, and you are paying this. Now when you take a loan, you have to pay interest on that also. So into 15% into 6 by 12. So you will end up paying an interest of 48 lakh 1,500 into 15% into 6 by 12. You will pay an interest of 3,60,112. So you have to pay not only this 48 lakh 1,500, you should also pay 3,60,112. So the total outflow under option 1 is 48 lakh 1,500 plus 3,60,112, which totals up to 48 lakh 1,500 plus 3,60,112. 51,61,612.5. This is your final cash outflow under option 1. Remember, you should also consider this interest, which many students will leave it. So this is what even ICA has computed. Now let us evaluate option 2. Option 2, what are they telling? They are telling you need not pay now, you pay me after 6 months, but you have to pay along with how much interest? 5% per annum. Then what will happen? You have to pay 50,000 pounds into 5% interest for 6 months, which will be, if my answer is correct, it should be 1250. Let us see what calculator says. Into 5% into 6 by 12. Perfect. 1250 pounds. That means totally you have to pay 50,000 pounds plus interest of 1250, 51,250 pounds you have to pay. Not now, after 6 months. After 6 months, what is the exchange rate? 99. So effectively you will end up paying 51,250 into 99, which is plus 50,000 into 9. 1 minute. 51,250 into 99, which is how much? 50 lakh 73,000, 50 lakh 73,750, which is what IC has also got. So if you see, if you choose option 1, your total payment is 51 lakh 61,612. If you choose option 2, your total payment is only 50 lakh 73,750. Now obviously which one you will choose? The option which is giving a lower cash outflow, which is my option 2. So this, my company should go with option 2. My company should go with option 2. My company should go with option 2. This is what this question is asking. It is a past examination question, so you can go through this once. Next, last question. This is the last question, because there is one small issue in ICA's understanding. I am not going to solve the first part. I am going to solve the second part, because first part is very, very simple. Second part only, there is a problem in the way ICA has answered it. So let us read what they have done in second part. Explain briefly the accounting treatment needed in the following cases as per AS11 as on 31st March 2020. Second part I'm going. Long-term loan taken on 1st April 19 from a US company amounting to rupees 75 lakhs. Don't think they are borrowing it in INR. Okay, just because sir they have mentioned it in INR, so it is not even a foreign currency loan. No, why will a US company give a loan in INR? They will give loan only in US. They have taken that US loan, they have converted into INR. That converted amount is 75 lakhs. Hey, please don't think it is an INR loan. If it is INR loan, no need to ask a question AS11. It is no use. So this is a US loan which they have converted into INR and given us as 75 lakhs. 5 lakhs out of 75 lakhs, 5 lakhs was repaid on 31st December 2019. Recorded at 70.5. Interest has been paid as and when debited by the US company. Okay, interest also is fine. Now if you see, when was this loan taken? This loan was taken on 1st April 2019. On that date, exchange rate was 72.5. That means this company in terms of dollars, they would have borrowed 75 lakhs divided by 72.5, which is how much? Just a minute. 75 lakhs divided by 72.5, 1 lakh 3,448. So this company would have borrowed this 1 lakh 3,448 dollars, which they converted at 72.5 and got 75 lakhs. So actually the US company gave this amount, not your 75 lakhs. Okay. Now on balance sheet date, the exchange rate became how much? 73.5. The exchange rate became 73.5. Now let us see how to solve this question. Okay. It's a quite interesting question. Okay. Initially in dollars, the amount was 1,03,448 and in INR it became 75 lakhs. Now in the 75 lakhs, the company paid out how much? 5 lakhs. They paid 5 lakhs on which date? 31st December 2019. On that date, exchange rate was 70.5. That means paying 5 lakhs at 70.5 exchange rate is equivalent to repaying how many dollars? 5 lakhs divided by 70.5, which is $7092. So effectively out of 1,03,448, this company has repaid $7,092. Sir, then how much will be the effective principal in dollars left? 1,03,448 minus 7092, which is 96,356. This is the number of dollars which is outstanding as at the balance sheet date. In terms of INR, it is 75 minus 5, 70 lakhs. Is this very clear? Okay. Now, out of 1,03,448, I have repaid $7,092. So what is balance? $96,356 is the balance. Okay, guys, this is not 0, this is 6. Okay, excuse my handwriting. 356. Now on the balance sheet date, that is on 31st March, the exchange rate is 73.5. So if you convert this 96,356 at the new exchange rate of 73.5, because this is a monetary item, which will be in terms of rupees, it will be 70,82,166. Now my liability in INR is only 70 lakhs, but now I have to increase it to 70,82,166. That means my liability is going to increase, and if liability is increasing, you also know it is a forex loss. So how much is your forex loss? 70,82,166 minus 70 lakhs, which is 82,166. This is your exchange loss. I hope you are clear with this. Now ICA has actually tried to confuse us. Okay, in my view their answer is not right. To be safe, they have itself mentioned in note in the suggested answer itself, there's a past question, they have itself mentioned that alternatives are also possible. So in my view this alternate answer which we have discussed is a more accurate one, which I have also given in the form of a table, which is the answer. Okay, there's a slight difference because of the decimals which I have rounded off in my answer, so you can go through this alternative answer which will be more useful. Okay, so this is what basically we wanted to discuss in AS11. Hope it was a good revision for all of you. Keep it very simple. AS11 consists only of 3 topics. First one is accounting of foreign currency transactions. In that, what is important? Initial recognition spot rate. As at the balance sheet date, see whether it is monetary or non-monetary. If it is monetary, use the closing exchange rate, restate it, and account for foreign exchange gain or loss. If it is a non-monetary item, don't disturb it. Okay. Now, there is a para 46A option. Go through that. That is applicable only for long-term foreign currency monetary items. Then coming to section 2, here the important part is the rules. Here you have to ensure that you are learning those rules well. These rules of conversion for each item, whether it is IFO or NIFO, it will vary. So go through this well. And in case of section 3, please identify from the question whether that guy is a hedger or a trader, because accounting changes based on that. Okay, hope you all would have enjoyed this revision video. We'll come back again with the next video on AS7, which is construction contracts. Thank you so much.